Hello and welcome back for Mali Investment Talks. I am Joseph Areu, your host. Again, I'm glad to be here talking to you about how to make your money work for you, how to grow your wealth passively. In our last session, we have started talking about investing for growth, for long-term growth. And at the end of the last session, I told you the one important tool that will help us or will help you to grow your income, rather to grow your wealth passively. It's probably the best tool known to the finance community, and it's called compounding, which essentially means reinvesting your gains, reinvesting your profits, reinvesting your interest. And I did indicate to you that there are two drivers of your compounded returns. And those two drivers are: one, returns or the rate of interest, and then two, time. In other words, if you can get the highest possible, if you can maximize the rate of interest at which you will be compounding your investment, you'll be doing very well. You'll get a good return in the end. But in addition, if you can maximize the amount of time, in other words, the time you spend invested in that asset, then that will be another way of maximizing your return from your compounding investment. So I would like us to start then by exploring how do you maximize or make sure that you get a good return from your investment, a good rate of interest, a good rate of return from your investment. A couple of very simple ways to go about it. The first one is essentially to negotiate or shop around for the best rate that you can find in the market. This may sound like a very straightforward, commonsensical approach, and indeed it is. But many of us either think that these interest rates are not negotiable, or we just don't make the effort at all. Yes, it is true that with a particular provider, you may not be able to change the rate that you're offered. But it is not true that all providers will offer you the same rate. So you should be able to shop around. So for instance, if you are in a bank, you're trying to buy a fixed deposit, well, Bank A might offer you rate X. Bank B could give you rate X plus 1. Bank C maybe X minus 0.5. So do move around and shop for the best rate that you can. Even if it is a unit trust provider, now unit trust investments are not they don't have a fixed contractual rate, but still you should be able to shop or check the track record of the provider or the asset manager you are potentially working with and see what kind of rates they have been able to achieve in the past. So in summary, once again, you try to select a provider, investment manager, bank, or whoever who gives you the best rate for a given level of risk, obviously. Now, one might ask, how do I know that a rate being given to me is a good one or it is not a good one. One basic, simple way of doing that is to do what we call benchmarking. In other words, compare that rate you are being offered to a market rate of one form or another. One of those benchmarks that is always available to us is the rate of inflation. If you are going to invest and you are being paid a rate of interest which is lower than inflation, then basically you are losing money, because the purchasing power of your money is going to be lower than inflation, which is not a good way to invest. So you want to make sure that at the very minimum, you are not receiving a rate of interest which is lower than inflation. Very simple and straightforward. And in any one of our countries, if you go to the central bank or if you read reports from the central bank, you will know basically every month what the rate of inflation is. At the moment in Uganda, inflation is around about 10%. In Kenya, I think it's probably around about that too, 9.5 to 10%. You can check in Tanzania, in Rwanda, but whatever that rate is, try to make sure that the rate of interest that you're earning from your investment is at best, or rather at worst, equal to that inflation rate, but better still, it should be higher than that inflation rate. Another benchmark that you can use is what we call treasury bills or treasury bond rates. We talked about treasury bills before. Basically, that is an instrument which enables you to lend your money to the government. So you can take the rate that the government will pay you as a benchmark rate, a rate to compare what you are earning to. So if the treasury bill, so right now in Uganda, for a 12-month or 364-day treasury bill, you would be paid somewhere in the region of 14-15%, although that is before tax. So after tax, you probably are being paid 10-11%. You can then use that as a benchmark to compare the rate that an asset manager might be able to offer you, or the rate that a bank is offering you for a fixed deposit. So that way, that is one way of making sure that the rate that you earn will always be a reasonable rate, better than inflation. The other point I need you to understand is that even small differences between rates of return will make a huge difference in the long term. So for instance, if provider A is offering you 11% and provider B is giving you 11.5%, that 0.5% will make a significant difference in the long term. Remember that you are compounding these returns. And so let me tell you, a difference of a 0.5% less, for example, on the rate that you get will mean that in about 30 years' time, if you held that asset for that long, the future value, the total amount of money that you will get would be about 16% less than what you would have got if you had a 0.5% higher return. If on the other hand, you got say a 1% less, so you had provider or asset manager A offering you 11%, then asset manager B is offering you 10%. And if you went with asset manager B, then you should be prepared to incur a loss of about 34% in the final value of your investment in about 30 years. That's a lot of money, my dear friends. So always pay attention to those small differences in rates. The second thing you would do, or you should do, to try and get yourself a competitive rate is to watch or check the investment costs. This is even more critical because this is where many times we as investors get a raw deal, because when providers, whether they are banks or asset managers, promote their products to us, they always tell us about the interest rate, how much you will be paid in gross terms. They very rarely tell you what we call the hidden details, hidden costs. So they will not tell you what will be the tax deduction. They won't tell you, in many cases, the fees that they will deduct, the management fees. And yet, ultimately, those deductions determine the real rate that you will earn. So you would want to check whatever they are offering you, 11%, 12%, 15%, how much of that is going to taxes? How much of that is going to management fees? Very, very important. It's important for, among other reasons, because of the fact that when we talk about compounding, it's not only the returns that you get which will compound, even the costs will compound. Okay? So, as high as the returns go because of compounding, the costs are also compounding. All right? So, let me demonstrate. I want to demonstrate to you the implication of a certain cost level to your investment, to your total return after a given period of time of compounding. Suppose you had a total initial investment of 10 million. And suppose the compounded rate of return, the annual compounded annual growth rate or compounded annual rate of return is 12%. Okay? And suppose you had invested for 30 years. All right? Then, before any deductions, assuming there is no cost or whatever, at the end of the 30 years, you will have earned about 299 million, let's say about 300 million. That will be the value on your account, starting with your 10 million. However, if you incurred an investment cost of, say, 1%, that could be management costs, management fees. By the way, don't get me wrong, there will always be management fees. There will be no investment out there which is cost-free. I am just saying that you would want to shop around and make sure you minimize on those management costs. If someone is giving you, taking away 1.5% instead of another one who is taking away 2%, you should go for the one who is taking away 1.5%. So, if your investment costs came to 1%, then the future value of your investment after the 30 years will drop to 228 million. That is a 24% drop compared to the value which you would have realized if there was no cost at all. If, on the other hand, the investment costs, management fees or whatever, came to 1.5%, so that is 0.5% more, then your total future value will now come down to about 199.9 million, meaning a 33% drop. So you can see, just by dropping, or rather by paying another 0.5% more compared to the 1%, for instance, you have incurred a drop in your future value and an additional drop of about 10%. So altogether now you are losing 1/3 of the total value of your investment. If, on the other hand, the investment cost, management costs and management fees is about 2%, you are now, in 30 years' time, you are losing about 42%. So you can see how dramatically a small change, it looks very small, it looks almost, infinite small, it's very, very tiny, how that small change in your investment costs, fees, or whatever can produce a significant drop or loss in return after a given period of time. So, in summary, once again, to get the best rate for yourself, number one, negotiate. Negotiate the rate. Make sure that it's equal to or better than a certain benchmark, inflation or treasury bill. Okay? And don't ignore those small little differences. Number two, watch the costs. And I couldn't emphasize this any better or any more, because these usually are not disclosed to us. It is your job to make sure that, ask the right question. Is this rate after tax or is it before tax? If it is before tax, what is the tax rate? What about the management fees? Okay? And try to go where your fees, your costs are competitive compared to other providers. So that is about return. The other factor that we talked about, which determines your compounded value, is basically time. Okay? The longer the time, the more time you stay invested without withdrawing your money, the more returns you will get. In other words, the benefit of compounding actually accelerate with time. Think about a vehicle whose speed increases with time. That is the way compounding works. So the longer you stay invested, the better for your investment. So let's demonstrate again how this works. In other words, how time, the amount of time you spend invested, will impact the returns that you get from your compounding investment. So suppose once again you are starting with an initial investment of 10 million shillings. That is Uganda money. That's about 300,000 or so Kenya shillings for comparison purposes. And suppose so the first thing I want us to do, I want to demonstrate, I want to compare a compounded return and a simple return. So suppose that a simple rate of return, for example, a bond. When I say simple, I mean it is not compounded. So like in a bond, whatever income accrues to you, the coupon just goes straight to your account. You just consume it, you use it, you don't reinvest it. So you're not compounding. As compared to a compounded rate of say another 10%, but this one, the income is being reinvested. Okay, so what will happen in year one, the simple return will be 11%, meaning 10 million plus 10% of 10 million, which is 1 million, that makes 11%, right? In the same year, the compounded value will also be 11% because it hasn't started compounding yet. It's being compounded annually. In year two, however, the simple value will be at 12%. It's fixed at 10% per annum. The compounded value will now have gone to 12.1%. So you can see that your compounded asset is earning you a modest 1% more than the simple, the non-compounding asset. All right? Let us fast forward. By year 10, your simple future value will be 20 million. So once again, think about, say, a bond. You are earning a coupon at the rate of 10%, and assume that you're just keeping that coupon in your account. Then the total, and suppose the bond is maturing in 10 years' time, then the total amount of money you will have, your capital plus your interest, will be 20 million. The same investment in a compounding asset will be giving you 25.9 million. So now the compounding asset has earned you 30% more. In 30 years' time, if we can just fast forward, whereas the simple future value is now giving you a total of 40 million. So again, think about a bond, started with 10 million and it was a 30-year bond. So at the end of 30 years, your capital plus all the interest that you'll have earned will come to 40 million. Now check what the compounded, if that was a compounded return asset, in 30 years' time, the total value of that asset will be 174 million. That is about, let's just say it's more than 4 times what you would have earned if you were not compounding. So that demonstrates to you the power of time in influencing the compounded returns that you get. So you can see in the first 1 year, 2 years, 3 years, the difference is not much. But if you keep it invested for a longer time, remember, each time you're earning interest, that interest is being reinvested and it's becoming an investment in its own right. So the total summation of all those reinvestments then really amplifies the growth of your assets, so much so that, like I said, in 30 years' time, now you have over 4 times more compared to if you were not compounding. If it went 40 years' time, 50 years' time, it would be even much, much better. So that is the power of compounding. It improves with time, but also improves with the rate that you get. So you can imagine if you are able to get the 2 factors together. Number 1, you've negotiated yourself a good rate. And number 2, you have kept your money for as long a time as possible. So if you are, for example, 25 or thereabout now, if you keep your money there for 25 years or 30 years, by the time you get it out, it's time for retiring. That will be a good time. I mean, you will have earned so much more if you had put it in a compounding asset than if you had put it in an asset which does not compound. And it's also one reason then why it's important, obviously, to then save and make sure that during that period of time, you are putting in whatever you can save in that compounded asset, because then you will take advantage of the power of compounding. So just as I end this, so let me demonstrate. Suppose you were able to save just a modest, say 100,000 shillings a month. That comes to 1,200,000 shillings a year. Okay? So if you were compounding that at a rate of just 10%, you can see that in 30 years' time, that will have grown to about 21 million. So that, say, lunch, 100,000 shillings a month is a lunch, basically. So if you can forego that lunch just once a month and you put it in an investment, say a unit trust, for example, you are looking at about 21 million shillings for yourself at the end of a period of 30 years. So as an investor, the true cost of that lunch to you is actually not 100,000 shillings. It is 21 million shillings, because that is what you are foregoing, thanks to compounding. Thank you very much. I'll talk to you again later in another session as we continue with Mali Investment Talks.